Uh, so super excited, Bill. Thank you for your time this morning. I know you're a very busy man. You and I have, many conversations the last couple of months, and I've always been interested in reading your call reports. There are, public financial information reported by all of the banks in the US under oath. And I'm very excited to talk to you today. We've prepared a list of questions. The main goal is really for investors, institutionals, LPs, sponsors, operators in the commercial real estate industry and multifamily where I'm in, to really understand kind of like the macro level and some of the major dynamics behind the scene. They're actually influencing and also informing where we are today. So I'm very excited to have you. If you want to do a quick introduction about yourself, BankRegData, and then we'll jump kind of right in.
Thanks, Adrien. I appreciate the opportunity to spend some time with you and your audience. BankRegData has been around for going on 17 years now, so I'm sort of growing old in the business. And the less than exciting name, Reg, is meant to tell bankers that we're looking at regulatory data. So you have GAAP data, which is going to be your public 10Ks, 10Qs for your publicly traded banks. But every bank is part of depository insurance is required to file to their regulator, the Fed, the OCC, or the FDIC, a call report 4 times a year on calendar quarter end. And it's about 1,100 data elements. So that changes for the big banks and the small community banks. But there's a core group of about 900, 950 elements. And what we're doing is we're ripping into that database, bringing the data down into our infrastructure, making it time series, showing context comparisons. And so you get a lot of information that's templated. Every bank files it. And so there's a lot of good information at a bank level, but there's also the ability to look at an industry level, right? And that's what's kind of cool from a macro perspective. So when we look at banks or we talk about banks, it's important to understand that we're looking at, government data that's reported to the FDIC, their regulator. It's what they're using to set depository risk assessments, their insurance rate. But it's basically going to cover the US depository, right? So when you're looking at the largest banks, they can have, infrastructure and assets sitting outside of the depository. What we're talking about is what's sitting on the depository, and that's going to be loans. So anything that's a multifamily loan or a commercial real estate loan, that's reflected in the data we'll be discussing.
Yeah, no, that's awesome. And so for people to understand your background, you used to work, I guess, as a creditor in the financial industry, and then you kind of went onto the dark side of like now shedding the light and really speaking the truth of like what you see, and some of the skepticism behind what's going on. And we'll talk a little bit more about it because there's different tools of the trades and regulatory changes that happened recently. And of course, cyclically we went through COVID and now we're in a different era and everybody's trying to understand what is the data, mean and ultimately what decisions should we take, but also some things that we were supposed to see happening, some sort of collapse or corrections that are actually quietly not happening. Correct. We're trying to understand, okay, what is the accounting telling me from a reporting standpoint, and what is technically reality of what we're seeing, day to day. So maybe talk a little bit about your background working in the industry, now what you're doing, and you publishing quarterly reports. You're also writing a very thorough newsletter, and I really encourage people here on the call to join and subscribe to your database. It's very, very meaningful information, and you kind of provide some thoughts and critiques and commentaries on what you're seeing with the data. I think it's very thorough and very thought-provoking.
So you say go to the dark side. I say become unemployable. My background is primarily credit risk collections, and banking and finance. So I started out, back in the early 90s, man, I'm getting old now, but basically doing predictive modeling in checks at Telecheck at First Data. And so I built the group that did that. So I'm very familiar with FICO. I built tons of models, and we also did that in the back end on the collection side. I jumped to American Express and did the same type of work in their international markets. So I have a very good feel for consumer credit cards, especially international compared to US. And then I flipped that over and jumped into Wells Fargo. And I will tell you, Wells has The bigger organization, usually the more difficult it is, right, to be entrepreneurial. But I'll say in the group that I was in, which was their small business lending group, some of the smartest people I ever worked with. And so we were building that group. It was unsecured lines of credit up to 250 grand. I was responsible for the analytical strategy behind how do you manage delinquencies. And so this was in the late 90s going into dot-com recession. We knew it was coming, and we had a very fast growing portfolio. So I did a lot of infrastructure around loan modifications, carrot stick testing on small businesses on how to, by the way, carrot never works, much like raising your kids, perhaps.
Right.
Carrot's good, but sometimes you need a stick as well. And that's what we found, right? People respond to negative stimuli better than they do positive. But if you give them an opportunity to be rewarded, here's the negative ramifications, here's the positive ramifications. You choose what you want to be on this. But, if you perform well, we'll basically lower your rate. If you don't perform well, we'll basically, shut down your line of credit, shut down. So we did a lot of testing in that infrastructure, and I learned a lot. And then basically did another check at a senior executive level, doing risk, collections, operations, IT, and then I kind of got fed up with it and kind of hung up my own shingle. So my background is credit risk collections. And what I'll tell your audience is it's important you understand where I'm coming from. I don't know if Adrien's setting the stage for this segue, but it's being a credit risk collections is what I would say collection background is both a blessing and a curse. It's a blessing because I know exactly what banks would be doing because I did it, right? And so how would I handle an increasing multifamily or increasing commercial real estate problem? I have a pretty good idea. And I also know if I got to rewrite the rules, they would have been rewritten exactly the way they were written. So you know who's writing the rules? It's the bankers. So I understand that. But at the same point in time, it's a curse because you see risk everywhere, right? So you have to understand I'm a voice in the chorus. I'm going to show a lot of data. I'm going to show a lot of numbers. But at the same point in time, there are green shoots. There are some encouraging things. You are starting to see big banks lend in commercial real estate a little bit more than they have in the past. And so the one nice thing about the business is banks only make up, we got about 1,300 clients, a little over. We got, 12,000 users, and banks only make up about 38% of that. So the majority of our clients are non-banks. They're going to be everybody you can think of. They're going to be regulators. The FDIC has been a client since 2012, FHLBs, Federal Home Loan Banks, Federal Reserve Banks, central banks, asset managers. I mean, from the biggest names to small family offices, private equity groups looking to buy commercial real estate, vendors and consultants. So we have counterparty risk, people that have money in banks and look at it and say, do I want my $100 million in these three banks, or should I think about moving my money out? So broker dealers. So we have a lot of viewpoints. And one of the advantages is I get to share information out, but that's a two-way road, right? So I've had quite a bit of education in other areas of the balance sheet, income statement, that's allowed us to kind of be a conduit information across. So, we've gotten to the point where we have a pretty good feel for how banks can manage their income statement. There are some things that are going on that should be concerning, but there's also some things that should be encouraging as well. The question
Right.
is the things that we're doing are sort of unprecedented. I'm still skeptical that we're the first people in 5,000 years of lending to think of these concepts.
Yep.
So I'm still
We're
of the
innovative.
opinion that the jury's still out, but I'm a little less pessimistic than I may have been about 2 years ago.
Right. Well, that's great. And I really appreciate all the background. And for people listening, let's jump into and briefly how even I got here, because I've been in the US for 15 years. I was in the consulting industry before. I was doing merger and acquisitions in Wall Street with big and large organizations, private equity groups, banks. But I've always been on the operational side. And then I moved to commercial real estate as an investor, an operator. We're working with private equity. We're raising funds. And we're trying to identify, pricing dislocation, which is distress, corrected basis, trying to buy notes direct. And now, obviously, all those foreclosures and deals that are quote unquote upside down, over levered back from 2021 when everybody went on a bridge debt at a high leverage. And having seen a lot of those deals and the compression of the cap rates and the non-performance of, the overall pro forma and then the correction of the basis, for years I was scratching my head trying to understand like what's going on. Like this doesn't make any economical sense. I'm a grounded, sound, I guess, person. I've been educated. I understand capitalism. I understand balance sheet and P&Ls. I also understand operations. I understand cash. And so ultimately trying to reconcile all of the numbers, nothing was making sense. And what I was seeing behind the scene is loan modification, banks saying they would do something and doing something else, the paper being securitized in a CLO, rolled up into a pool, and then ultimately some of those sponsors not necessarily be held accountable for quote unquote their mistakes, because ultimately they levered the capital from the bank, and the capital from the bank is levered from another bank or the markets. Right. So I got really excited to talk to you because your knowledge and exposure and seeing what's going on in the market really gives me the idea that I'm not crazy, and what I'm seeing is actually based on signals that are more like macro level. But two, as an investor, like you said, there's positive out there, and you can either be on the skepticism side of things and wonder like, hey, we're not all playing with the same rules. The world is unfair. Well, so be it. That's what I teach my kids every day. The world is not, fair. But at the same time, there's different things we can look into eventually to take advantage. So that being said, I would say let's jump right into, I guess, one of our first questions is, how do we even got here? We've all heard, we've been printing so much money, and your latest newsletter also talk about one of the massive, I think it's $888 billion assets that grew in the industry, which is the second largest time after COVID. And a lot of it is trading related, not necessarily lending related. Right. So quickly, like, how do we got here? And what do you see right now? Like, where do you think we are in the cycle?
So let me lay a backdrop on this. The scars from 2008, 9, and 10, and 11 run deep, like shockingly deep. And so normally, I learned a long time ago, all the constituents sit at a table, right? A round table. And you got banks, you got equity, which is investors, the asset managers, you got owners, you got employee, you got regulators, you got customers, consumers, and you got society, right? You got the general. So there's this round table, and what theoretically is supposed to happen is we all talk, and ideas and impulses get managed in that group. What I will tell you is after 2009, 10, and 11, with all the pain with REO, everybody's on the same side of the table now. So that means asset managers, and this is an aside discussion, but I'm not convinced stock options for management is always the best thing. Because basically what it does is 100%, and I've seen this firsthand. I fired 250 people in my last run as part of it, which was the nail in the coffin for me working in corporate America. Management basically was bought out by the bankers, our lenders, to give us hey, you're better off shutting it down, and we're going to encourage you to do this in your decision making, and we're going to give you money. And basically selfish interests from management being 100% aligned with owners' equity allowed us to do things that we really didn't need to do. Selfish interest played out as opposed to being able to make it an ongoing concern, which we were doing. We were making it more profitable. But that's an aside. But what that means is when we sit there and worry about what's happening now in 2023, 24, 25, understand the backdrop is we don't want pain. Pain doesn't get us reelected. And we always have a re-election campaign. Doesn't matter if it's a blue tie or a red tie or whatever the tie is, we're going to push off pain. And then the reality is nobody ever wants to take the pain. Even if I get reelected, I still don't want to take the pain. So everybody kind of does the same thing. So the backdrop is everybody's trying to avoid the scars from what happened before. The other backdrop to this is we dumped $5.5 trillion of money in the system in 2020, 21, and 22. This is not arguable. It's demonstrable. And I know people are like, no, dude, inflation is monetary. There may have been other things that were at play, and I'm not discounting those, but we went from $14.5 trillion of money in the US banking system, and deposits are a big part of M2, right? M2 money supply, a huge part of that is banking deposits. So this is not me talking macroeconomics. This is me looking at the data going, holy shit, we went from $14.5 trillion at the end of 2019 Q4, $14.5 trillion of deposits in the banking system. That climbed $5.5 trillion to $20 trillion in a little over 2 years. So 2.5 years. So what that meant was, you can argue if it was warranted or not warranted. Don't care. I don't think it was personally, but I'll set that aside. What it did is it created a very real problem for banks, because that's a liability. So on the balance sheet, banks have $4.5 trillion of deposits, because there would have been some normal money supply. So I'm not going to give it all to this, but there was probably $4.5 trillion excess, 4.2, 4.5 in that ballpark. So that's a liability. And we then taught an entire generation of bankers that 0% interest rates are forever. We've come up with a new paradigm. So I've noticed in my talkings, there's a very different real world experience talking to people 38 and younger and 38, 40 years older. Your frame of reference is a younger 38, 37, 36-year-old, now senior manager or banker or policymaker or executive, is that 0 is the normal baseline. And so what ends up happening is we taught a generation of bankers that, hey, 0% interest rates are here. You take that $4.5 trillion of cash and you don't need to hold it. You need to go buy stuff. You need to go buy securities, or you need to lend. And so when we say, how did Silicon Valley happen, Silicon Valley Bank, it happened because you got a bunch of 35-year-old managers at that bank that thought 0% interest rates were forever. And they were loading up on $100 billion of extra treasuries and mortgage-backed securities at 1.8%. And so they just never fathomed a world. Well, that didn't happen in isolation. That happened because of government policy, right? That happened because we taught people 0 was normal, and then we dumped a bunch of money. So the wave of problems that we had in 2023, 2022, late with Silicon Valley and Silvergate, mark-to-market losses, was 100% because of that wave of money. So that wave of $4.5 trillion that flowed in, the banks that went out and got securities were the ones that got in trouble first in 2024. That's worked its way through. So yes, I look at securities now and I'm like, man, treasuries are really getting out of control. And then I talk to all our broker dealers. I'm like, should I be buying, right? And like, no, stay the hell away from long end. You don't ever want to do that. So you see them losing the bond market, right? They are, and I can't comment if that's permanent or short-term or whatever, but basically the banks that lent are now getting themselves in trouble in 2024, 2025. So where do you reach? You reach for yield, you're reaching commercial real estate, you're lending like crazy, you're levering like crazy. And so the problems that
or you rewrite the paper in itself, which is correct. One of the things that to me is incredibly hard to understand is ultimately when the cash disappear from operations, people are not paying their rents, they're not collecting the fees, the leases are getting canceled. We see it in the apartment buildings, we see it in the office buildings, like the real tangible cash generating activity has dissolved. Then ultimately somebody is not paying their debt service. The paper is maturing, but what is happening behind the scene is beyond the normal, hey, let's reduce the yield, let's create more runway, let's do a modification and an extension. Like we're way beyond this point. Now we're literally artificially keeping the paper alive when we know that paper is not worth anything anymore. Or a very substantial smaller amount of it.
It's worth 70 cents or 65 cents or 80 cents or whatever the value is. But the problem we run into is we inflated the asset value of everything. And part of that is just inflation. It is. It's 35% more money was dumped into the system. But part of that is excess, right? It's people reaching. So we don't really know what the value drop could be. And I don't know. I mean, so if we say, well, 35%, and that's what it was. If you take, 4.5 trillion and you divide it by 14.5 trillion, it's like 33, 35, 40, 38% in there, depending upon what you think's
Right.
excess or not excess. But if that's in the system and that's not going to go away, then maybe housing that's gone up double, maybe that only comes back half. And that's what the new baseline is. So we don't know how much of it is overvaluation and how much of it is inflation, and that's now the new standard. So what my pet, and I got a lot of sayings, but one of my pet sayings is, I don't know how we solve an overvaluation problem without value destruction. And so what we've done is because we're all on the other side of the table now, right? Nobody, except for our kids, right? Our kids want value destruction so that they can now look at a life that we had and our parents had, and they're not staring that in the face. They're staring at a much different situation, getting into resi or whatever, getting into jobs. So what's happening is we don't worry about that because that's a long-term problem. The short-term problem is we can't have a cascading. So you got former regulators of the FDIC out there telling everybody the biggest problem we made in 2009, 2010, 2011 is we didn't modify enough loans. So very clearly that's been the book, and we'll walk through this. The question is does it work? And I don't think it's going to. And the reason for that, and I'll demonstrate some numbers shortly, and maybe this is the good segue, is it isn't just a commercial real estate or multifamily problem. We are long in the tooth on a credit cycle. And so the reason we have economic cycles, or at least historically have had economic cycles, is that banks have to lend into a bucket of a barrel of credit. And coming out of 2010, 11, and 12, banks weren't lending. So what happened is people repaired their balance sheets, whether it's a business or a consumer. They repaired their balance sheets. They got good. That they were able to be a lot more restrained in their borrowing. And so what happened is that barrel of credit became full of some very good credit-worthy people. There was a lot of cream at the top of that barrel. So when you look at the loan growth in 14, 15, 16, 17, 18, they were lending to a very good group of people. But the problem is you start taking people out of that barrel. So, Wells takes somebody out, Bank of America takes somebody out, community banks take a bunch of people out. As you get longer in the economic cycle, it is a self-regulating system. And I say this as a lender, having done it, you're working your way into a less credit-worthy group of people, businesses and consumers. And so we were starting to hit that in 2019. You saw every portfolio was getting worse. The delinquencies were starting to climb. Then conveniently or magically, that flood of money washed everything away. So the barrel was empty, right? Use the metaphor. The barrel was empty. There was not a lot of good credit-worthy borrowers left in that barrel for banks to lend to. We dumped $4.5 trillion in. We said, don't make your mortgage payments, don't make your rent payments, don't make your student payments. Well, what do those do? Well, that empties the cup of debt for the borrowers. So every borrower fills up a cup of debt, and it's a cup of debt servicing. And the reality is most businesses and consumers run pretty high on their cup of debt. Well, how do I grow anymore? Well, you got to empty the cup of debt. Well, how do I empty cup of debt? Modify loans, sustain mortgage payments and credit pay, consumer, right? And then just give money. So what happened is we did all of this stuff that started to refill the credit barrel. But the people that we were refilling the credit barrel with was artificial. It was fake. So you expect this regulating cycle. Yeah. And then at the exact same time, banks had all that extra money. You had all these people that appeared to be good and credit-worthy people. Now we're in a pickle. We're in a real pickle. And we're in a pickle, not just in commercial real estate and multifamily, but in everything. Consumer, C&I, construction, auto. I mean, you name ag, you name the portfolio, you're seeing delinquencies do this. Now, I can share some of the information to show. We do have consumer and commercial real estate, especially non-owner occupied, which is rental income. That's where the payment stream comes for the loan. It's called non-owner in the FDIC speak. But basically, those look like they've peaked. And that's where we've had the most, what I would say, manipulation and massaging of the processes to give the illusion. And so, I'm happy to start digging into some data.
Yeah, let's look at some data because And what you said, I put this in parallel with what we've seen here on a more micro level in terms of what we call syndication. All of a sudden, you had groups with, like you said, the mid-30s, no experience, no balance sheet, starting to borrow 40, 50, $60 million with a artificially inflated PFS, personal financial statement. And those banks would, land like 80% plus LTV on a forward-looking pro forma of an operation, an apartment building, which was almost speculative, like it could be stocks or anything else, based on some what they call trade-out reports. But those trade-out reports were also inflated by the customer who were receiving rent relief, PPP money. Some
Right.
people had 2 or 3 jobs. They were moving from California to Texas, and so it's the to me the double effect of the artificially inflated top line based on quote unquote fake customers as we were printing money and helping those people out. And I remember I had friends literally writing PPP loans to like everybody and their grandfather, right? Or their daughter. It was just completely out of control.
Yep.
But at the same time, people were using this economics to do loan origination and underwriting. And so the whole thing was inflated, and then they would borrow at a higher, leverage on a much lower rate. And that's where you see the cap rates, NOI over your total capitalization. You're looking at, or pricing, you're looking at the cap rates that went from like an 8 to 7 to 6, all the way down to a 2%. Like some apartment buildings were trading at a low 2 cap rates, which to me was completely unbelievable. And now we're seeing some of those groups because the pricing has been readjusting. And like you said, we're now in a massive correction or destruction of value. But the question is, was that value in the first place real? I don't think we're in a destruction of value. I think we're actually we're closing the gap, and you and I, we've done accounting, and we're closing the gap between intrinsic value and book value. Like what is in your recorded book financial statements is going to get closer to what's called reality, which, we're all using like accrual basis, cash basis, whatever accounting, ways to measure value. Ultimately, what's on your books at a single point in time, which is your balance sheet, or when you do your annual reporting or your Q1 or whatever, it has to be as close as possible to reality. And I think we're in a historical time where the gap between reality and what's in the books is definitely, really, really wide.
Correct. Yes. Yeah. There's no doubt but understand the backdrop is not, nobody at the table, and our kids don't have a seat at the table, but nobody at the table wants to go back to 2019 valuations. Nobody. The government doesn't, the taxes don't, the politicians and policymakers don't, because you don't get reelected. You have a lot of social engineering outcomes that we've got to continue to demonstrate were the correct things to do, primarily in housing, but it's not just in housing, it's in SBA lending too. So it's an owner-occupied lending. The delinquency rates in owner-occupied government-backed paper is ridiculously high.
I saw that.
To the point where you're like, why are we still allowing these banks to do this? It's not only poor social engineering, it's corporate welfare, right? And I don't begrudge the banks doing it, because if I was a bank, I'd do it too. But you've got a lot of parties that don't want the bad outcomes to start unraveling, because the fear is it can quickly get out of control. So what I'm going to do is
and it's happening quietly, obviously.
It is.
I mean, every day we're seeing foreclosures, we see bank taking back some papers and all of that. Right. It's not to the extent that we would, I guess, have anticipated.
It's dribbles. Yeah. And I spent a lot of time on Zillow looking for the next place, because my wife and I have a bad habit of wanting to move every 5 to 6 years. And now we're getting 5, 6 years, so we're getting itchy. So, I look at a lot of markets, and you're now starting to see foreclosures and auctions start popping up, which you didn't see that for a long, long time. I still think they're massively withholding that, but they can't control everything. So I think what they're trying to do is more of a controlled, stretch this out as long as we can to where the valuations or inflation help us grow back into the values, and the pain is a malaise as opposed to a baseball bat up to the head, right? And I think that's what they're trying to avoid. So what I've come to tell people is, look, we may be in this environment where we just fudge the numbers for the next 7, 8 years, which means low job growth. I mean, everything looks great on paper, and as long as no one's ever held to account, does it work? Maybe, but I don't think so. And so the reason I don't is I'm going to come into the industry. So once again, for everyone listening, we're basically pulling the data from the quarterly call reports from the FFIEC. So if you're ever curious about where we're pulling it and what we're doing, you can come in. We'll show you exactly where the data is coming from. Adrien referenced some articles. I put out one article a month. I'd like to do more, but it takes about 3 or 4 days to put it together. This, unfortunately, because of AI, AI is great. Well, it's not great as a small business contact that's putting out content, right? So unfortunately, we had to push a lot of this behind a free trial firewall, but you're welcome to sign up for a free trial. There's no credit card, no obligation, none of that stuff, but it'll walk you through how we look at the data. And we do reviews on CRE, we do reviews on NDFIs, or these private credit loans you've been hearing about. And that's going to be a mess. We haven't spent any time talking about this, but that's a way for banks to go out and get more credit out of the credit barrel. Understand, everything goes back to a bank having to lend. And as you work your way through the economic cycle and you refill it with fakeness and you still fill through that, who's left to lend to? How do we get economic growth? So policymakers want economic growth, which means banks have to lend. Banks want to lend, but they don't want to hold capital. They want to pay dividends. NDFIs are this magical thing that allow us to have growth, never report the delinquencies, and then still show that we're basically able to generate, because we hold less capital against them. So we're able to have more income and dividends. It's a win-win. Well, dude, we didn't create some new way of lending. I don't think that's going to play out well, but we have a bunch of articles that walk through how we use the data at a bank level as well as at a macro level. So I'm going to go to the industry section, and don't worry about the loans 2003 or loans 2012. This is the most granular data set that's available. And so at an aggregate level, look at the loan growth, right? It's starting to take off. It's starting to become massive, which is stimulative. Right? So if you're sitting there saying, is this going to work or not work? Well, if we start stimulating the economy through loan growth, maybe we can grow our way out of this. And I think that's kind of the approach that they're taking. And I also think whenever I see the big banks all do something at the exact same time, there's no way it's organic. It's someone's coordinating policy. And we noticed about 3 quarters ago that banks started to lend again. Primarily, they were only lending in DFIs. So if we come down here, we look, there's your delinquency rate. They skyrocket, they stabilize, and they're kind of stabilized. But in that red chart, there's a lot of constituent portfolios that have different trends. The restructured loans, the orange one, shows you that we've modified 62 basis points of total loans. But that number is fake as a $3 bill. And I'll walk a little bit through that. But we had to change the rules so that you and the vast majority of, educated, sharp people in the business, but don't know what's going on behind the scenes at the table, they look at this and say, well, looks like loan modifications are coming down. But that's not at all what's happening. What we've done is in 2023 Q1, we wiped away $59 billion of loan modification recognition. We went from 72 billion to 19. And we didn't wipe it out. We just stopped reporting it. So all of a sudden, we lowered those loan modifications to a much lower base. And you used to be able to see it in the data, and I can still show it to you. But now that we're 3 years past this, hey, that's a long time ago, and I can't see it in the data anymore, so this must be the right thing. But we did 2 things. We wiped away $59 billion of loan modifications, and $33 billion of that was in mortgages, by the way. So you have to ask yourself why we have so many modified mortgages in the greatest housing market of all time. But now no one even can see that data. But then surprisingly, they started to modify and go back up. But what happened was two things. We reset the baseline and lowered it. And then we said, there's a new rule in place where you only have to report what's been modified in the last 12 months. Well, anybody that's managed collections goes, well, that's very clever. Because what I learned at Wells, and every other banker managing collections and risks knows, is yeah, the reason people still can make payments for 12 months is because you lowered their payment and you negotiated it to a level that they could commit to do. In fact, if they went right back into delinquency within 3, 6, 9 months, the regulator would come in and slap you on the hand because you're not supposed to be modifying loans that are delinquent near charge off. The internal regulators at risk policies at Wells, I was a big modifier. I modified 1.5%, 2% of our portfolio, but it was unsecured lines of debt. And they're like, dude, you make up 15% of our loans and 65% of our loan bonds. I'm like, yeah, because they're all doing it wrong. But yeah, because you're 28, you think you know everything. But from a risk perspective, it makes a lot of sense to do this. The problem is you have to put them on non-accrual. And when you put those loans on non-accrual, and that's the point behind them, is you want to pay down the loan principal. You don't want to recognize fee and interest income. The problem with that is you stain it with the scarlet letter of a non-performing loan. So even if the guy is making payments, you still have to report it as non-accrual, non-performing. And that we can't have, right? So what they did is they changed the rules and said, look, if you make payments for 12 months, you don't have to report it as TDR, loan mods. So in 2023 Q1, we wiped out 59 billion. But what they really did is they quietly changed the rules that allow you to modify the loan again after 12 months. And I know so that's the case.
I want to be very clear here for people that are listening, and even myself, because we're talking about putting something that is a liability on your balance sheet and pretty much taking it out of your balance sheet so you don't have to report this risk. Right. But what they did, because having studied, historical America, every instances of financial crisis, the preliminary was when a large company, and I'm not going to name them, started to do what was called off-balance sheet, reporting and activity. It was like, here is my liabilities. Oh, by the way, sorry, I have other liabilities over here. And so what you're talking about is both a change in reporting, but also what they did is a reclassification of what that liability is and where it should be on the balance sheet. So they're remapping the account. They're not calling this accounts payable anymore. They're calling this something like, oh, I owe some money to a friend of mine, and here is the new account.
So there's yeah, and we haven't even talked about that. And I'm glad you brought it up. And what I'm doing is I'm not being, I my apologies. I'm not trying to be disrespectful, but I mean bringing up banks to give examples of the things that you just referenced. So there's two things that happened. We have a massive overvaluation problem, and you could argue if I'm right or wrong or not right or wrong, but commercial real estate is overextended, right? So we don't know what the right level down is. And I think it's higher than what we may expect based upon prior cycles. And the reason for that is we inflated too much money into the currency. So we're never going to go back to 2019 on housing. Babe, I told my wife, you want to get that, that second home in a retirement place, it's great. You're not going to expect 2019 prices. We'll come down, but we're going to come down to an elevated, inflated level. So there's a value destruction component, and how the parties on the other side, all on the same side of the table, have decided to deal with this are two ways. One is we just modify the crap out of everything, and that becomes so obvious. Guys like Bill Moreland are sitting there, go, "Whoa, look what they're doing," and so we have to change the rules. And then Bill Moreland's like, "Yeah," but nobody believes it because the data looks different. Now I got to trust this guy that I don't really know, and he seems like he knows what he's talking about, but he's got a bad credit risk view of life, so maybe he's just negative. But the second thing that was done was a ton of note-on-note financing. And so what I saw during 2021 and 2022 was all of a sudden our business exploded. If I talked to a private equity group that had a war chest of 200, 300, 400, $500 million that they raised and then levered up, I signed about 9 out of 10 of them as clients, you guys included, right? And it was an easy sell to show stress is coming in. But what's happened is we basically have done a bunch of note on note financing deals. And so I view this as a big sloshy pool of liquidity. And I think some of this money, and there's a cycle that I saw on REO. There were some brilliant, very aggressive, smaller people, shops, and some bigger ones. But early in 2009 and 10, they were impressive. Then as that aged, there was copycat money that floated. Then there was the big money. And it's like, okay, we're going to do this. And then the big money came in. And then kind of hey, I was able to go out and raise 300 million. And you talk to them, you're like, shit, dude, that guy could raise 300 million bucks. They're smart people, but they're tangential to the business. It's not their core competency. And so you're like, maybe we're starting to attract people that seems a little sloshy, right? And then you got the people that are like, hey, I learned about BankRegData at a seminar on how to make money on REO. And now you've gone full circle. And so I've always looked at the CRE note buyers kind of in that same framework. And that got very accelerated. It almost seemed like we collapsed into hey, I learned about CRE at a seminar on how to make my CRE. I learned about BankRegData, CRE on how to make it. So I don't know how much of the money that was floating out there falls into each of these buckets. But I sure thought there was a bunch of people who were buying note on note financing deals that it seemed aggressive. And what I mean by that is, hey, we think these properties are worth 68 cents on the dollar. That's what we offered. But that's not what we did. And we want to walk through and see what you're hearing from other people. And the bank told us put in 20% equity. And then they lent us, and then they took a 4% charge off, and then they lent us the other 80% of that spread. And I'm like, okay, but that's 96 cents on the dollar valuation, right? And I'm like, how does it work at 68 cents and 96 cents plus interest? And they're like, well, we think we've got a better way of doing it. We've got a longer horizon. It's a small portion of our portfolio. And okay, but when you hear everybody doing it, you can't all have a better way, right? And you can't all. And then you heard some of them said, well, look, we can afford to take risks on a small portion of our capital. What it also does, it allows us to stretch our capital stack. So instead of putting in 68 cents on only a number of deals, we can now triple or quadruple the number of deals, and we view it as a portfolio. And I'm like, okay. And then you heard, Bill, I had 3 years to deploy this capital. We're now coming up on 24, 28 months. If I don't start doing it, the investors are going to claw back our war chest. I'm like, okay, now that's the one that makes sense to me, right? So I heard 70-30 in the beginning. You put down 30%, you put down 70. From that perspective, from the bank's perspective, you're changing the loan to value on that to where a regulator, an outsider, a skeptic like me would say, hey, you know what? Okay, that almost kind of works, right? If it's worth 68 cents and you get yourself down 30, but then you heard 80-20. Then you started to hear 90-10. And then you started to hear from clients saying, hey, two separate clients mentioned this. JP Morgan Chase is shopping a $300 million loan in a city that we're in, and we know the property, and they offered us 90 cents on the dollar to take it off their balance sheet. Non-recourse, 2 years. And I'm like, okay, they started at 90. So you view this pool of sloshiness, and it goes from 70-30 to 80-20 to 90-10. So you're working through that initial group of money that was being deployed from all these war chests, and you're seeing the banks having to get a lot more aggressive and encouraging people to take it off the balance sheet. So I'm like, well, 90-10 almost seems worthy. Non-recourse, you just rent the net interest margin for a couple years. They're like, yeah, we know the property, it's going to be re-rented, and it's going to take a 40% hit on the income, on the rental income. And then you're like, so you turned it down. They're like, yeah, we turned it down. Guess what? They came back and offered 100 cents on the dollar. Two parties, unrelated parties. Within a month, I heard that. So when you go and you look at JP Morgan Chase and you look at those delinquencies climb up and you see them come down, You see, you go in and you basically look at their non-owner occupied portfolio. You go to non-performing loans. I was hearing these stories right this time frame. Then you see a $300 million drop 3-4 months later. So when you look at this drop from a 343 or 1.2 billion to 937 million and 2.62, what do you believe? If I'm ignorant, looking at this data without our client base being so kind of spread out in a lot of different areas I never knew even existed, if I'm just looking at this data talking to an asset manager or a bank CRO or CLO, chief lending officer, hey, it looks like JP Morgan Chase's commercial real estate delinquency is really starting to get better. So the two ways that we are managing these delinquencies is we're modifying like crazy, and I'll talk about that with Bank of America and Flagstar and commercial real estate multifamily, or we're just pushing them off the balance sheet for 2 years. So I don't know if I can trust this number. And so part of my job is, look, there's nothing in the reporting anywhere that the regulators would even know that they dumped a $300 million, $280 million property, bad loan off their balance sheet and made it an NDFI. And so what happened is their NDFIs, basically, it would go into an NDFI section. Look at the massive growth. So there is nothing in, and now NDFIs make up 16% of their total loan book. It's the largest by far. And so how much of that, and there's some data in here that we started asking for in 24 Q4, but there's nothing in these breakdowns that tell me, hey, how much of it is self-funded note-on-note financing deals where the commercial real estate is still on your books? It's just two years off of being kicked back over the wall non-recourse. There's no way to know. And so I think everybody's heart is in the right place. There are a lot of very talented people in a lot of different areas that I deal with. I don't think there's anybody that isn't trying to do the right thing in a way that helps keep the system from experiencing a repeat or an echo of 9, 10, 11, and 12. But at the same point in time, I don't think we know the right things to be asking, right? So yes, there are note-on-note deals, and they are basically moving off of commercial real estate. And so when you come in and you look at the non-owner delinquencies for JP Morgan Chase, they go up, they go down, they started to go back up, and I said that's the echo. So the echo is the modified loans that you did at one point in time, and you can see the massive loan modifications that were taking place where they peaked out at 566. But understand, you can see that we started on a low base, and you can see this right there. 23 Q1, it went to 0%. That is not the correct number. The correct number is actually up in the 20-25 basis points for that portfolio, but we wiped out all knowledge by just not reporting it anymore. So understand, when you see this 42 basis point to 36 basis point, 150 to 129 drop, it didn't drop. They just stopped reporting it. So it's still on their books. So know that they're taking loans off that were modified here. So for the number to keep stair-stepping up so much, those modifications are probably upwards of $800-900 million. They just don't have to report them anymore. And so now they magically start to come back down. You see the charge-offs basically start dropping and then going back up. But what you end up with is an echo. When we modified loans, what we learned is they looked great for 12 months. And then months 15, 18, and 21 is when those lower payments came back as a rebound, and they started to experience more delinquencies. So
because everybody's thinking, and I keep hearing all the time, Bill, like, we're gonna, like, and we have a new Fed chairman, nomination, I guess, today. Everybody's expecting rate cuts, and everybody's gonna be like, oh, we're gonna get back to wherever we were, right? Which is this artificial point.
We gotta get back to baseline.
And I'm like, what are you talking about? Are you talking about us reprinting another $5 trillion? Like, we're going to grow the national debt to 50 trillion? Like, or do you think we're going to have another COVID? Like, those were absolutely once in a lifetime we would expect, right? Events. But they've used that as the norm, and they're comparing everything to it. And even now, when people are buying real estate, like you were saying, they're comparing it to 2021 pricing, and they're saying, oh, this is a discount. Or they're taking a note, 100% assumable at 100% leverage, and they're like, oh yeah, but we're going to get better. And what I do is I'm looking at the actual original underwriting during the loan origination that was done like 4 or 5 years ago. I'm looking at the rents, I'm looking at the operating expenses, and I'm like, how is this going to get better anytime soon? Like, this is not going to happen. Like, we're not going to reduce cost of insurance. We're not going to reduce property taxes. And that's a whole different topic of what people are trying to do to escape property taxes with tax exemption structures and whatnot. But ultimately, the average workforce, America, affordable housing, whatever, cannot pay more than X amount, of whatever they earn as a salary to pay for the rent. And so those rents are basically sealed to a level, and people thinking we're going to go back to this timeline and the Fed is going to rate cut back to 1% or free money at 0%. Like, this is not going to happen. And we're in the pain for the next few years. I've also heard actually the Fed may increase the rate, and we may have another hike of 25 or 50 basis points because of the inflation. And the inflation is driven by what we discussed, but also you're looking at the geopolitical factor of like the war in Iran and, the disruption of AI and technology, a lot of the job losses. And then those companies, like you said, are also tied into, I got to publish my next quarterly report and I got to increase my price per share. And so you're in this game
but you've
of
seen
thrones.
The conversation about that.
I mean,
maybe we should change the SEC requirements to every 6 months.
Yeah.
They said that. That came out. So you understand, right there is the nub of this. They'll just change the rules.
Yeah.
We cannot. And so the other thing you said is, hey, another $5 trillion of money come into the system. Dude, we're printing an excess $2 trillion every year right now as part of the budget.
Yeah.
So we're printing 40% of that excess money every year. And it has been for the last 3 years, right? So that money's flowing in. And so you can fight that tide all you want. I'm just too conservative by nature. And so I'm very skeptical. So my personal stock market picking is, dude, miners, and that's about it, right? Much to my chagrin, right? And so you can't fight these things from happening. But what is going to happen is, will it continue to work? And so you look at Bank of America. They were the second largest commercial real estate lender. JP Morgan was number 3. Now they're number 2. Wells is by far number 1. But you look at the non-performing notes and, non-owner occupied, and you're starting to say, well, yeah, we hit about 6%. But you notice that the numbers are starting. That's a 10-year chart right there. They peaked. They went super skyrocketed super fast. But Bill, they're down to 2.93%. And so you look at the charge-offs on this, and they've come way down. But I would say look at the mods. But what you have to realize is at one point they were reporting 8.5% of their book is being modified. Well, I would surely hope your delinquency rate would come down 6, 8, 10 months later if you're modifying 8.5% of your book. But it's not 8.5%. Because what you have to realize is it's like a Ferris wheel. You have a loan modification TDR Ferris wheel. And when you modified a loan and you put Bill Moreland's business on it, or Bill Moreland personally, I went on the Ferris wheel, worked my way around making payments, but I never could get off. So the more people you crammed onto that Ferris wheel, it could only get bigger. And so you see it getting bigger, 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 bigger. But with the new 2023 Q1 rules, they were able to wipe out. They went from over 1.25% to 58 basis points. But what do you see happening? 3 months, 6 months, 9 months, 12 months, people get off the Ferris wheel. 3 months, 6 months, 9 months, 12 months, people are getting off the Ferris wheel. So I believe that
every time it gets
higher.
It
gets higher and
because ultimately we all know the amount of interest being accrued is way beyond controllable. It's like if you go and get 5 credit cards today and all of a sudden you stop making payments, they're all jump to 22, 25% APR. Right. You're never going to make enough money, and your children and the children of your children, to right. eventually pay off those interests. So it's going to end up being a write-off, a default, which is going to imply your credit score going down. And then tomorrow you're pretty much off the marketplace because you can't borrow money anymore. So right. the banks have to find a way to, one, keep you alive so you can continue to borrow, and two, eventually not having too much debt with the next generation, but they're going to have to somehow write it off. And that's going to, I mean, this is a whole conversation on the dollar value, which I have a lot of, also skepticism in its all. But for people here on the call, and I know we are getting to the, hour here, and this is so, I mean, we could spend a whole day talking a lot about different data points, but, there's some false truth out there that I really want to be careful with. One, I really don't think we're going to get back to any 2020, 19, 21, 2020 prices. Like, this is not going to happen. Two, comparing yourself to this point in time and saying now you have a discount or things are getting better, I don't think so. And three, when people are starting to think, oh, we've reached rock bottom and things are going to improve from now on, I would say be careful, because this is not as easy as we think. Like you said, it's bleeding. They're putting some Band-Aid. They're, patching and reworking and cleaning, but eventually it's going to have to find its way out. And to your point, it might take 6, 7, 8, 10 years from now. Correct.
Yeah. So multifamily looks a lot like commercial real estate in terms of the delinquencies going up, and the modifications, and are they going to go back to whatever the valuation is, less inflation, whatever that, where we're at from 2019 to inflated to overvalued. But this is Flagstar. And by all intents, this is another one of these banks that created, we got to change the rules. So as much as I sit here and say there's going to be a reckoning, I have seen more rule changes in the last 4 years than I saw in the prior 13 of this business. And this is one. So what you're looking at here is you modified $123 million of loans. Then the number jumps to 216, and then it disappears. Flagstar is bankrupt. So we're going to talk about 2 rule changes. That's people getting off the Ferris wheel. They're still modified, but they're off the Ferris wheel. And then somebody got on the Ferris wheel, an extra 100 million, 90 million, and they immediately got taken off. And that's not supposed to happen. You're supposed to at least wait 12 months and act like you're reporting responsibility. But then lo and behold, is that the same group of money from there?
They're coming back.
Maybe. I don't know. But this is the 2 rule changes in 100%. One is you take it off 12 months. And now there's 3 rule changes. You take the reporting of the modification off for 12 months. And then you now can remodify the loan. Now, I don't know. There's nothing in the call report or the 10Ks or 10Qs that say, hey, and analysts in Wall Street should be asking this question, but you have to understand, analysts at Wall Street are on the same side of the table as management. They do not want the party to end. And I've had presentations where I've talked to very big asset managers, and the only ones that want intellectual honesty, and I don't mean that cruelly, but the only ones are the shorters. All the long shops, well, that's not going to happen, or because that's their book, right? They don't want a cascading problem. So there is nobody on the other side of the table. So is this a previously modified loan? And so now you can start to keep your delinquencies. We'll never show delinquencies or charge-offs ever again. But the third thing that we did that changed the rules was exactly from Flagstar, is they're bankrupt. And they should have gone under. In a normal world, they should have gone under a year and a half ago. But about a year and a half ago, we changed the rules that every quarter, the regulators announce we have 75 banks for $4.5 billion on the troubled bank list. And guys going back, remember this back in 2009 and 10, because they reported on a Friday. And what happened is on a Monday, the stock market would go down 500-600 points, back when 500-600 points meant something. So they stopped reporting that, started doing shotgun marriages. We no longer had failure Friday, we had shotgun marriages. And so you never knew they failed, but they failed, right? It's just they weren't reported. There was lost share, there was all kinds of stuff going on. So for 5 decades, we've reported the number of banks and the aggregate assets of the troubled bank list. A year and a half ago, we don't think there's any value reporting the assets anymore. We're just going to report the number of banks. Really? Could it be because the number would be 5 billion, 5 billion, 5 billion, 105 billion? And then everyone could go out to BankRegData and look for $100 billion banks, and there's only 7 or 8 of them at that time that went into the troubled bank list, right? And so Flagstar, they changed the rules to hide Flagstar's bankruptcy because nobody could absorb them. But I'm going to tell you, somebody will, and it's probably going to be JP Morgan Chase. We'll wait another 6 to 9 months, maybe a year, but Flagstar will be a great turnaround success, and they're going to get sold to somebody big, and they're just going to keep getting bigger. So look, I can't.
And no impact to the taxpayers neither, right?
Yeah, beautiful, right? It's a win-win-win-win. But what it is it's manipulating markets and reporting at levels we've never done. And so the last thing, and I'm happy to go on in time, but I know your audience has other things to do, but I'm skeptical that it's going to work, because if I look at delinquencies and NPLs, you're seeing them climb across the board, right? And they're not higher than they're not ridiculous. This is back in the oil fracking days, but they're higher than they were in 2019. And why do we think it's going to cap out at 102? And you have to understand, they're modifying this portfolio like crazy too. So there's a bunch of things that are going in to modify, to keep that number suppressed. But you start cycling through this, look at mortgages. Look at the jump in the mortgage. These are delinquencies in mortgages in the greatest housing market of all time. And granted, these are all government guaranteed mortgages that were never being charged off, that are being worked, but they've inverted. And so I'm not saying that it's horrendous, because if you look longitudinally, hey, we're still okay relative. But dude, why do we think it's going to stop where it's at now? The stress is in the system, and it's building in the system across tons of portfolios. Look at construction. Look at construction. So what is happening is you're seeing it in owner occupied too. Here's owner, and this is a bunch of SBA 7, but look at that massive jump. Look at the jump from 81 basis points to 91 basis points. And once again, now, well, Bill, you're being negative because we're only back to where we were in 2018 and 19. I'm like, yeah, but why do you think the trend is going to stop? And so what's happening is we don't just have a commercial real estate problem or a non-owner problem or a multifamily problem. We're dealing with those to make it the appearance that those problems are less than they were and everything's great and you shouldn't worry about it. But all the other portfolios are starting to show stress and delinquencies. So we're threading a lot of needles, and they may pull it off, but the rule changes are having to become more extreme to hide what we're doing. And the last note is, I've heard from fairly high level people that of the largest banks that are modifying mortgages, 40% of them are on their second or third loan modification. Why are we doing this? Why? Why does this make sense? It makes sense because everybody's on the same side of the table, and the only rational people that are going to pay the price are the next generation.
And that's the thing. I'm hearing we're buying time. There's no such thing as buying time when the time you bought has already been like 2, 3, 4, 5 years. I mean, it's like, and I'll use the NBA analogy, right? It's like we've been on overtime 5 times. Like somebody has to win and somebody has to lose. And I'm sorry, but this was very, very informative. And I really want to encourage, at the end of the day, as I bring all of these data to, an operator, an investor, like someone that kind of play on the sideline and trying to be part of the capital markets, borrowing money, but also generating cash and running an operation, cutting payroll checks, hiring people, paying taxes, paying insurance, paying utilities. Like we're all invested where real estate is a real tangible asset. It's not Silicon Valley. It's not, a speculative venture capital, valuation going from 0 to 100x overnight. It's like, it's brick and mortar. It's people calling those places a home or an office. They go in, they go out, they pay the lease every month. And so what I really want to encourage people is in a line sight of like looking at all of this. When you do your underwriting, when you do your valuation, when you're trying to understand the operation, the business you're trying to buy, really, really make sure you're not, focusing on the fees and how much money you can turn around and how much, this is going to grow your portfolio and the number of units and everything else. Like truly, truly, truly as a standalone operation, how much this places is generating cash and can I pay my liabilities behind the scene? And be careful with how much money you borrow, because that's the challenge. I mean, we can all walk to a shop today and get a $20,000 credit card. But if you do that 10 times a day for the next 10 days, well, you're probably going to get to a place where you can't pay it back. Yeah. And now you have to turn around and ask your kids, are you willing to pay my debt, right? Because those credit cards are going to be yours one day. And so I think we got to be very, very careful how we play the game, how we understanding those rules and where we're investing. And like you said, make the number works. Everybody can make the number works on a spreadsheet. Everybody. Yeah. But when it comes to, operations, I mean, you were saying, and I'll close there, Bill, I've also been in positions in my life, and I was a controller. I was doing financial consolidation. And one day I got called by the president of the company and the HR. And we brought about 150 people in the office, and we were laying them off. Yep. And some people have been working in the company, and I won't name the company, but for like 25, 30 years. Yeah. And they call security. People were packing their, pictures, plans. They were crying. They were escorted out the door. And I remember that day, I came home. I told my wife and my family, I said, I will never put my family in a situation like this where, I lose my job, I get fired out just because one company needs to make their next quarterly, earnings, because the company was profitable in the first place. Yeah, it was still growing year over year. It just wasn't. We were still growing. We were doing fine. Yeah. But we had to make a signal, and it translated into 100 families having their dad or their mom or whoever coming home and saying, "Hey, I don't know how I'm going to pay the bills next month," and that's to me is where eventually, quote unquote, shit hit the fan is when people are getting hurt. And we got to be careful with, borrowing capital, playing the game, but ultimately we're responsible as asset manager, investors, operators, owners, we're responsible for people's jobs. And when those jobs are getting, in tension because we can't pay those bills, I think that's where we have to be very careful. So yeah. Anyway, if you give me one more screen share, because I promised I would not try to be the Pied Piper of doom. And I think perhaps I've done it with a nice smile, but there is one thing that should be encouraging. And so I didn't cover this, I spoke to it, but basically where I'm at is industry, off balance sheet, unused commitments, commercial real estate. So these aren't going to be the same loan portfolio categories I showed earlier of owner occupied. That level of granularity is not there. But what shows up in commercial real estate is owner occupied, non-owner occupied, multifamily, and farmland. It's non-residential real estate. Yep. But notice this is unused commitments that have been extended. The number was getting hideous. And I kept telling everybody, if they're telling you that commercial real estate's going to be turning around, don't believe it until you see that number grow. Because they may say one thing, but if the bank is not lending, if the industry is not lending, that means, and so you just see that number drop $127 billion. But it inverted and it's accelerating. So
that would be the green shoots or the, you know, hey, there may be some optimism in the space. I think part of this is the banks are being encouraged to do this because I think there was a quid pro quo of, hey, we'll change all these other rules, but eventually you have to basically, there's going to be a price to this rule changes. You need to start lending again.
Yeah.
But I think some of this is genuine because I talked to a lot of commercial or community banks in the 10, 12, $30 billion range, which these are good, big guys. And they're like, dude, we're going to lend again, right? You know, I appreciate your negative comments, but we think there's some optimism in the space. So understand that there is growth taking place. It's not all negative news. So there still is,
No, I agree.
There's still people out there that want to take the money and there's still people willing to give it to them.
And we're seeing it too in our space. Like we see demand picking up. We see collections picking up. I think, you know, we're seeing some positive signals too.
Yeah.
And obviously all of this new supply, all of this inventory is getting absorbed. And so at the end of the day, if the fundamentals are healthy, which to me, it comes down to supply and demand, cash, ability to pay, job growth, population growth, like real economic factors that, you know, influence real estate, I think we're starting to see some positive, 100%. Yeah. But I think the story is very different depending on the market and the sub-market. And so you have to look, yes, you have to look at things because if you buy a property a couple of blocks and there's like 4 foreclosures around you and everybody's slashing down their prices, you're in trouble. If you buy a property right here and there's a new HEB or whatever, and there's growth, then eventually you're going to make it. But those decisions, you have to be very careful. So anyway, I'm very thankful, Bill, for your time. Always a pleasure to hear what you have to say. I really encourage people to, you know, look at your data, look at your reports, maybe subscribe. Price is very reasonable compared to other database out there. And yeah, I look forward to maybe continuing the conversation.
I appreciate it. You have a good day, sir.
You too, Bill. Thank you.
Bye.